Hi, this is Ken Brownlee with the Brownlee Group coming to you about mortgages. I know everybody that's wanting to buy a home, they have to have questions regarding, what kind of mortgage, not only that, but what kind of credit score. And this is the topic for today. And I have today Jim Gaffney with AmeriFirst. Jim, thanks for being here.
Thanks, Ken, for having me. I appreciate it.
Oh, my pleasure, actually. Thank you. He's been in the business for years, and he is my go-to guy, and I want to bring him here. And really, let's just start off. What is a credit score, and what makes a good one?
Good question. So, to start off with, credit or credit score really is your financial lifeline, if you will. When you think about the number of things that you need credit for, we'll go through a couple of those, like your job. Getting a job, you need good credit for the most part. Applying for a home loan, applying for car insurance, getting a cell phone. In today's environment, they check your credit to get a cell phone. So super important that you have good credit for these things. Car insurance, you're going to pay a lower premium on your auto insurance when you have good credit. So many reasons to have good credit. What is a credit score?
Yeah.
A credit score is a scoring system. It's a risk system from low to high. So you hear the term, my credit's in the 800s, my credit's in the 700s. What does that mean? Well, credit score is going down to the lower to middle, lower 500s is considered low by standards of risk factors. Credit score is going upwards of, I'd say over 700, 720 is really where you start to get into that excellent place. Above 780 would be stellar. So really it's just a scale of the lower your score, the worse it is. The higher score going towards that 820 point range is the better that your credit is.
Now, I assume there's more than one company doing this. How many companies are really giving you a credit score, and what do you look at?
Yeah, so there's three companies, Ken. There's Equifax, Experian, and TransUnion. These are the three major credit bureaus, and each one of them has their own algorithms of risk factors as to what they look at. There's a credit a chart here that we can display for you to better illustrate what a credit score is made up of and what these three entities are looking for in your credit. So the first one is the credit mix. That represents 10% of your credit. And what I mean by credit mix, Ken, is that we all have credit cards, right? But when you combine credit cards with installment loans, maybe student loans, different types of credit, store credit, auto loan credit, they're going to have different reporting factors that affect the strength or the weakness of your credit. So 10% is the credit mix. New credit, right? So new credit represents also 10% of your credit score, meaning credit that has been opened in the past 12 months.
Yeah.
In the past 12 months is really impactful on your credit score compared to credit that's
good or
older.
bad impactful?
Bad impactful, for the sake that those credit bureaus don't like newly established credit. There's some risk layers that have shown that people who are applying for and advancing more credit more recently can be a higher risk, as if there's a immediate need for income or for money, for cash advances. So credit that's taken out within the past 12 months is going to affect your score.
So including that, like some people say shut their credit card off, close them down so their credit looks great, or they go borrow money to make it look like they can afford it. What would they do, or what's the mistake that some of these people are making on their credit score?
Sure. One of the biggest mistakes is to close a credit card. One of the larger reporting factors on your credit is the seasoning or the history of your credit. So when you had that credit card that you co-signed with your mom when you were 18, don't close it out, because the depth and the history that you have in that credit card is substantially helping your credit. So keep old cards open. Certainly, want to recommend keeping as low of a balance as possible, or no balance, but some balance is okay. But don't close out that old card that you haven't used in a while, because it's helping keep your credit score as good as it is.
Okay. And old commercials I see on TV, have your credit run, see if there's anything bad. How would someone run their credit, or where would they go and find this information?
Yeah, a great site, a public site that's free, that's owned by Fannie Mae is called annualcreditreport.com. That's annualcreditreport, no S, report.com. And that's a great resource, a great free site to go ahead and take a look at your credit, understand your credit profile before you start the home hunt especially. And you can do that at no charge by just going online yourself.
Now, that's a good question before you go hunting for a house. How would somebody, in your opinion, wanting to buy a house, we got John over here that wants to buy a home, should he look for a home, or should he get a line of credit, or is it just to review the credit? I mean, exactly what would that process look like?
Yeah, well, there's two things that person should do. One, surround himself with financial professionals that know what they're doing, because having a professional guide you through that process is super important. The second thing that person wants to do is to educate themselves as early on in the process. It's amazing. I've looked at thousands and thousands of credit reports and spoke to thousands of people. It's amazing how many consumers don't know who they owe and how much they owe. So get informed as a consumer before you start your home search to know how much you owe on a monthly basis and who you owe it to. You might be surprised. And by the way, just as an example, there's some leveraging of your credit debt. So if you have a car loan, let's say with a $400 a month car payment and a very low balance on it, that may move the amount of money that you can qualify for upwards of $100,000 just for that $400 debt. So that's why speaking to a professional is going to be super, super important, because that person may recommend, pay off that small debt. Let's increase your buying power and get you the home that you want and not feel restricted to a home that you're going to get squeezed into qualifying.
Perfect. Now, you brought up buying power, which is vital. I think people need to know what their buying power is. One of my, I hate to call it a pet peeve, but mine is you're not spending their money. You're just telling them what they qualify for. They need to live in their means as well. And I know you can't say that to them in the sense of, because you don't know their budget or anything else. Is there something that you sort of give them an idea, like, well, you've been paying rent for $1,200, now you're going to go up to $2,600. Is that really wise? I mean, do you ever run across that, or is that something that just truly is something that they have to deal with?
Well, the standards have been put in place by Fannie Mae and Freddie Mac that says, hey, we don't want to lend to somebody over or at a 50% debt ratio, meaning how much you make divided by how much you owe should not exceed 50%. Somebody makes $10,000 a month, they shouldn't owe more than $5,000 a month. That's considered a 50% debt ratio. So what we do is just encourage somebody within those debt ratios to be responsible with how much they owe on a monthly basis and how much they're looking to borrow that's going to increase or alter their monthly payment. And we try to keep them well below that 50% space. But sometimes it comes up where to get the home they want, they get a little bit up towards that 50% mark and push the limits.
Okay. And with that, and you'd say, let's say, pay off your credit card to get rid of that payment because now your 50% gets lowered so their buying power is stronger. Is that the kind of thing you were saying? Or
yeah, exactly. Working with a pro, we are going to tell you to, we're going to structure the loan, especially in the environment now with multiple offers, competitive offers. We want to structure your loan to where you're getting the house that you want. And that might mean in some cases putting less money down on the home and putting more money towards paying off small and revolving credit debt that can actually open up the doors of your buying power.
Okay. Which is another good point that you brought up is in today's times, this is 2021, the first quarter, and having someone to go look at a house and not qualified or haven't finished their paperwork is really detrimental to them in this market because they're very competitive. They need to go in, and what do you call it, pre-approval, or what are the terms that somebody would want to have to take in their corner to go make an offer?
Yeah, in yesterday's environment, a pre-qualification was just an industry standard, which meant you had a conversation with a lender or a banker, and maybe as a result of that conversation, they printed up a letter and said, hey, everything looks good. In today's environment, if you want your offer to get accepted, you really need to go a step further and have your loan, ideally a fully underwritten loan pre-approval, where the lender's actually reviewing your income and your assets, all your pay stubs, like a full financial packet That way your offer is going to stand out, or we're going to elevate that offer over competing offers, because the listing agent and the seller know that your loan is a lot further along than your competing offers, in the sense that your loan's already been underwritten.
And that's a vital point in my eyes, because I do a lot of listings. I do work with buyers, but I do a lot of listings. And if somebody sends a pre-qual letter, what we call, it's just a generic, if you answered a certain questions, you got to a certain point. If that buyer, well, he wants to be at the top of the list, like you just said, have a pre-approval letter, have everything done in the underwriting, and you're home free. In today's market, that's just the way to go, or what you need to do. That's fantastic that you do that.
Yeah.
Not many people do, I can tell you.
Absolutely, and we're finding that it makes a difference. It makes a difference. So when there's 10 offers out there, the listing agent, traditionally, highest isn't always best, right? You'll hear that term, but
all the time.
But the listing agent and the seller are going to go with the offer that's the most confident offer. The most confident offer besides cash, right? Besides cash, is a fully underwritten loan approval, and that's going to give them more surety that they can start their next chapter and plan their departure goals and plan the money that they're going to get from that sale as a result of your loan approval compared to a competing offer's pre-qualification.
Yeah, because I think it's vital in today's market, because I assure you, as a listing, we don't want to just take a loan that's quote highest. It's who's pre-qualified to get us to the finish line, because so many letters that are pre-qualified are not really checked or underwritten, and something just shows up on their credit or bites the whole deal, right? So, well, thank you very much. Now, for someone what would you recommend for someone that actually wanted to repair credit or do something to their credit to help them? What would you recommend?
Yeah, the first thing you want to do is know who you owe, right?
Okay.
Know who you owe. If you've had late payments in the past, obviously you have to pay on time. It represents about 30% of your credit score, is your payment history. So it's really important that you're starting to pay on time. The second piece to that is it's so important that you pay down your credit cards. So when you have available limits, and then you have your current balance, and those two numbers are very close to each other, also known as maxed out, as an industry term, we say, oh, they're maxed out on their credit card. Go as far away from being maxed out as you can. Get your credit balances as low as possible. You can control your credit score. Ken, your credit score is just a snapshot at one moment in time. So if on a Monday I have a Target credit card with a $1,000 balance on it and a $1,000 credit limit, that's maxed out. I'm at 100% usage. Fast forward a week later, that balance is now $100 and my available limit is $1,000. I have very good usage on that card. So a credit retrieval on this week compared to the following week is a different credit profile, and I can actually raise my credit score just by controlling those credit balances.
So changing the score is vital, because is the interest rate a flex? Well, let me rephrase. Is the credit right now, where is it? Is it going up or down? It's extremely low, I know, but
the interest rates are still one of the lowest price points in history. We're in the mid to low threes, which is super. However, the interest rate environment is credit driven. So most loan programs are going to price their loans based on the credit score. So someone could pay a different rate for the same house just because their credit score was lower than the next person. And that can result in thousands of dollars of interest over the life of the loan, simply by not having the right credit score when you purchase.
And can you help them with that, or talk to them?
Yeah, I mean, we do credit consulting. We also do free credit repair as a courtesy, as a service level on your path to home ownership. There's times where we're repairing someone's credit the day before they're in contract, and we're getting it done right at the 11th hour to get that extra bucket. Credit scores go in 20-point buckets, we call them. So someone's interest rate is going to be different if their score is 660, 680, 700, 720, 740. So something simple like paying that Target credit card, like that example, may elevate you to the next tier. That next tier may give you a little bit of a lower interest rate, which means a lower payment. If you're putting down less than 20% and you're paying principal mortgage insurance, also known as PMI, that's also going to change your PMI downward. So it's going to reduce your PMI by having a lower credit score.
Okay.
And we do all the above. It's just part of part of what we do, and we understand that people have credit challenges, and we just make that part of our path to home ownership.
Okay. If you were to pick a loan, I mean, there's so many different types of loans out there. What do you recommend? Is it based on their income or their debt, or is it the type of loan? Because I know they all have their benefits and their purpose in life. How would you advise or suggest, or how would you handle that?
Yeah, no, it's a great question, and I guess they say is the right loan for the right home for the right buyer.
Okay.
There's the right home for the right buyer, and there's the right loan for the right buyer. So if you're a veteran of the U.S. Armed Services, 100% we recommend going that route. It's an extremely, extremely beneficial loan that affords you to put down really no money for the most part as it relates to the loan. If someone has had credit challenges in the past, or maybe credit events like bankruptcies and foreclosures, judgments, collections, luckily the current lending environment still allows that person to get financing through what we call FHA or government financing. So for that person, an FHA loan would be the best fit. For someone who has a little bit better of a credit score, maybe a little bit larger of a down payment, a little cleaner credit history, we recommend conventional financing for that person. And when it's in the middle, we allow them to choose. We provide both examples of what that's going to look like, short-term and long-term, and we allow the consumer to decide which program they want.
So you helped us out a lot. How can they reach you, and how can they reach you? Is there a number or an email?
Yeah, they can go to the Gaffney Mortgage Team on Facebook. My phone number, my cell phone number for those viewers, I'll give you my cell phone, which is after hours and weekends availability, which is area code 631-252-8500. You can email me at jgaffney@amerifirst.com. I'll include that in some of the comments or link below. And certainly reach out if you have any questions about home ownership, or just, maybe you work with another lender and just want an answer just as a resource. Feel free to count on me.
All right, great. Thank you, everybody. Listen, I can't stress this enough. Before you buy a house, definitely talk to a lender and talk to a real estate agent. Strategize and plan. This isn't something that you can do overnight. You really want to plan ahead. And sometimes it may take 6 months or a year to get your credit score changed for 5 points or 10 points to get a much lower interest rate. And sometimes we can change. I personally, just so you know, I've taken FHA loans because of what I wanted to do with that home as opposed to a conventional loan, and I'll just change. And that's where a professional will come in, and Jim will walk you through that process. He'll ask you questions, and you can tell him what you're looking for, and he'll direct you wherever you need to be. He does a fantastic job. If you like this information, do me a favor, subscribe to our channel, look at us on Instagram and Facebook. If you have any questions that we can answer in the next weeks, please just send me a quick note, let us know. Thank you again, Jim.
Thanks, Ken.
Appreciate it.